Welcome to another enlightening discussion on the intricacies of ETFs. Today we delve into the topic of SCHG versus SPYG. As the world of investing continues to evolve, exchange-traded funds, or ETFs, have emerged as a popular and effective way to diversify portfolios. These investment vehicles, which bundle together a collection of stocks, bonds, or other assets, offer a way for investors to gain broad exposure to different sectors, industries, or investment strategies, all under one umbrella. So, what's on the agenda today? We're shining the spotlight on two specific ETFs, SCHG and SPYG. Each one of these funds offers a unique approach to investing, and throughout this video we'll be dissecting their differences and similarities to help you understand how they might fit into your investment strategy. First up, we have SCHG, the Schwab U.S. Large Cap Growth ETF. This fund focuses on large U.S. companies that exhibit signs of above-average growth. Next we have SPYG, the Spider Portfolio S&P 500 Growth ETF. This fund tracks the performance of the S&P 500's growth stocks. Each of these ETFs operates within the growth investing space, but they have unique characteristics that set them apart. As we delve deeper into each fund, we'll explore aspects like their investment strategy, performance history, risk factors, and more. Keep in mind, we're not here to tell you which ETF is the best. Rather, we aim to provide you with the information you need to make an informed decision based on your personal investment goals and risk tolerance. So, whether you're a seasoned or someone who's just starting out, buckle up and get ready to dive deep into the world of SCHG and SPYG. As we journey through this comparison, we'll unravel the unique features each of these ETFs possess. Hello, viewers! If you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us. And remember to comment and share. Let's kickstart our discussion with SCHG. Delving into the world of exchange-traded funds, or ETFs, SCHG, also known as the Schwab U.S. Large Cap Growth ETF, emerges as a key player. This ETF, managed by Charles Schwab, offers investors an opportunity to invest in the largest U.S. companies that exhibit strong growth characteristics. So what does the investment strategy of SCHG look like? It's quite straightforward. SCHG aims to track as closely as possible before fees and expenses the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. This index is made up of large-cap U.S. stocks that demonstrate a growth style of investing. By mirroring this index, SCHG offers a broad exposure to large-cap growth stocks in the United States. Let's delve a bit deeper into the portfolio composition of SCHG. It comprises a diverse range of sectors, including technology, consumer discretionary, healthcare, and communication services, among others. This broad sectoral exposure ensures that the risk is well distributed and not concentrated in a single sector. And what about the performance of SCHG? Well, over the past decade, SCHG has consistently delivered strong returns, outpacing many of its large-cap growth peers. The ETF has demonstrated a remarkable ability to capture the upside in rising markets, while limiting downside risk in falling markets. This balance of growth and risk management makes SCHG an attractive option for investors seeking long-term capital appreciation. In terms of fees, SCHG prides itself on its low expense ratio, which is significantly lower than the average for large-cap growth ETFs. This cost efficiency makes it an attractive choice for cost-conscious investors. So there you have it, a snapshot of SCHG. It offers diversified exposure to large-cap growth stocks in the U.S., has a proven track record of strong performance, and comes with a low expense ratio. That's a snapshot of SCHG, our first ETF. Now let's switch gears to SPYG. Now we turn our attention to SPYG. The SPYG, or the Spider Portfolio S&P 500 Growth ETF, is an exchange-traded fund that's been making waves in the investment world. It's a fund that focuses on growth stocks within the S&P 500, meaning it seeks out companies that are expected to grow at an above-average rate compared to other market-listed companies. The investment strategy of SPYG is straightforward yet effective. It aims to provide investment results that, before fees and expenses, correspond generally to the total return performance of the S&P 500 Growth Index. This index is a subset of the S&P 500 and includes companies exhibiting the strongest growth characteristics based on sales growth, the ratio of earnings change to price, and momentum. Now, let's talk about the portfolio composition. The SPYG holds a diversified portfolio of over 120 companies across various sectors. The top sectors represented in this ETF are information technology, consumer discretionary, and healthcare, reflecting the areas where growth is often most pronounced. As for performance, SPY has consistently posted impressive returns. Over the past 5 years, it has outperformed the broader market, demonstrating the potential benefits of focusing on growth stocks within the S&P 500. But of course, as with any investment, it's important to remember that past performance is not indicative of future results. Investing in SPYG carries risks, including the risk that you may lose some or all of the money you invest. Therefore, as with all investments, it's important to do your own research or consult with a financial advisor. So, in a nutshell, SPYG offers a focused way to invest in the growth segment of the S&P 500. It's a fund that targets companies with strong growth characteristics and has a track record of strong performance. With SPYG now in focus, it's time to bring IWI into the picture. Our first comparison will be between SCHG and SPYG. Let's dive into the world of ETFs and examine these two giants. On one hand, we have SCHG, which stands for Schwab US Large Cap Growth ETF. This fund aims to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. In simpler terms, SCHG is all about investing in large US companies that are expected to grow at an above-average rate compared to other companies on the market. On the other hand, SPYG, or the Spider Portfolio S&P 500 Growth ETF, also focuses on growth companies, but it seeks to closely match the returns and characteristics of the S&P 500 Growth Index. So while both ETFs have a growth-oriented investment approach, their strategies are based on different indexes. Now let's talk about portfolio composition. SCHG's portfolio is heavily weighted towards the information technology sector, with significant positions in consumer discretionary and healthcare sectors. It's a bit more concentrated, with its top 10 holdings accounting for over 40% of the total portfolio. SPYG, while also leaning heavily into the information technology sector, has a more diversified spread across other sectors such as healthcare, consumer discretionary, and communication services. Its top 10 holdings make up a little less than 40% of the total portfolio, providing a bit more diversification compared to SCHG. Moving on to performance, it's a bit of a mixed bag. Over the past 5 years, SCHG has slightly outperformed SPYG, but the difference is quite small. It's important to remember that past performance does not guarantee future results, and both ETFs have shown strong returns over the long term. So, in terms of investment strategy, both SCHG and SPYG are growth-oriented, but they track different indexes. In portfolio composition, SCHG is more concentrated, while SPYG provides slightly more diversification. Performance-wise, both have demonstrated strong returns, but SCHG has slightly edged out SPYG in the past 5 years. It's also worth noting that while both ETFs have very low expense ratios, SCHG's is slightly lower, which could make a difference for cost-conscious investors. However, the difference is minimal and should not be the sole deciding factor. In conclusion, both SCHG and SPYG are solid choices for investors seeking exposure to growth-oriented, large-cap U.S. stocks. Your choice between the two will depend on your investment goals, risk tolerance, and preference for index tracking or portfolio diversification. That concludes our comparison of SCHG and SPYG. Next up, SPYG versus IWI. Next, we delve into a detailed analysis of SPYG. Let's get started. SPYG, or the Spider Portfolio S&P 500 Growth ETF, is a fund that focuses on growth stocks. To start, let's look at its investment strategy. SPYG follows the S&P 500 Growth Index, a subset of the S&P 500 that includes companies with strong growth characteristics. This index, focusing on growth stocks, is more concentrated, with around 500 companies. This means that the SPYG is a focused fund in the growth sector. Moving on to portfolio composition, SPYG holds a large portion of its assets in the information technology sector, which is typical for growth funds. This could mean higher potential returns for SPYG if the tech sector performs well, but also more risk if the sector underperforms. In terms of performance, SPYG has shown strong returns and could be a suitable investment choice depending on your individual goals and risk tolerance. Another key feature of SPYG is its expense ratio. It has a relatively low expense ratio, which means it costs less to own. However, as always, it's important to consider the total cost of ownership, including trading costs and potential tax implications. Lastly, let's look at the fund size. SPYG is a large fund with more assets under management. This could mean more liquidity and potentially lower trading costs, but it also means the fund could be more susceptible to large market movements. So, there you have it. SPYG, with its focus on growth stocks, offers a distinct investment strategy, portfolio composition, and performance history. It has its own strengths and weaknesses, and the right choice will depend on your individual investment goals and risk tolerance. That's SPYG for you. Now let's move on to the next comparison, SCHG. After dissecting these two ETFs, we can see how each one has its unique strengths, and we've journeyed through the intricate world of SCHG and SPYG. Two ETFs that are as varied as they are robust. They each offer unique opportunities for different types of investors, with their own individual strengths shining through. SCHG, for instance, stands out for its focus on large-cap growth stocks, making it a solid choice for those seeking growth potential in their portfolio. Its low expense ratio is also a noteworthy feature, making it a cost-effective option in the long run. On the flip side, SPYG, with its impressive exposure to the S&P 500 Growth Index, provides a broad and diverse range of growth stocks. It's an ideal choice for investors who wish to tap into the growth potential of large-cap U.S. companies. However, as we've seen, each of these ETFs also has its own set of weaknesses. SCHG, for instance, may not be the best fit for those seeking international exposure. SPYG, on the other hand, is a bit more expensive than its counterparts. But what does this all mean for you, the investor? Well, it's simple. There is no one-size-fits-all ETF. The best choice depends on your individual financial goals, risk tolerance, and investment horizon. The key is to understand what each ETF offers and how it aligns with your investment strategy. As we wrap up this exploration, remember that investing is not a sprint but a marathon. It's about making informed decisions that will benefit you in the long run. It's about understanding the nuances of each investment option and making the choice that best fits your financial objectives. Before we sign off, we want to leave you with one final thought. In the world of investing, knowledge is power. The more you know, the better equipped you are to navigate the financial markets. So, continue to educate yourself, stay informed, and keep exploring the world of ETFs. Thank you for joining us on this journey through SCHG and SPYG. If you found this video helpful, please subscribe, like, and share. Until next time, keep exploring the world of ETFs